He still has the hoodie. It's gray, slightly faded. The company logo is peeling at the edges. He doesn't wear it anymore, but he can't throw it away either. Because for 3 years, that hoodie meant something. Late nights, sleeping under his desk, telling his parents, "I can't visit this Thanksgiving. Things are crazy at work." It meant believing he was early. His name is Daniel Harris. At the time, Daniel was living in San Francisco. Like most early employees, he had relocated to the Bay Area for the job. Not a founder, not an executive, just employee number 30-something in a startup that, at its peak, was called the future of work. You probably remember the headlines: $1 billion valuation, SoftBank backing, offices in glass towers across major cities, a charismatic founder talking about changing how humans live and work. The company was WeWork, and when it collapsed, Daniel walked away with nothing. No payout, no windfall, no life-changing equity. Just a severance email and a hoodie he couldn't bring himself to donate. This is how a billion-dollar company can exist, and the people who built it still end up broke. Daniel joined WeWork in early 2016. At the time, it felt obvious. Everywhere you looked, the company was expanding. New locations, new cities, new press. Friends asked him, "Isn't that the place with kombucha taps?" Yes, and free beer, and a mission statement that sounded more like a religion. But what really sold him wasn't the perks, it was the equity. During onboarding, HR explained it carefully, but not too carefully. "You'll receive stock options," they said. "If the company goes public, this could be huge." They didn't say how huge, they didn't have to. Daniel did the math himself. If the company was already worth billions and he owned a tiny slice, even a tiny slice of a very big pie still felt like something. So he accepted lower pay than he could have earned elsewhere. That was the trade. Cash now or ownership later. He chose later. To understand what happened to Daniel, you have to understand how startup equity actually works. Not how it's talked about, but how it behaves when things go wrong. Because equity doesn't mean ownership the way people think it does. Daniel didn't own shares, he owned options. Options are permission slips. They give you the right to buy shares later at a fixed price. That price is called the strike price. At WeWork, Daniel's strike price was low, but not zero. And that detail would matter more than he realized. At first, everything went up. Valuations climbed from hundreds of millions to billions, then tens of billions. At one point, internal documents valued WeWork at $47 billion. Daniel refreshed TechCrunch like everyone else. $47 billion. On paper, his options looked incredible. On paper. But here's the uncomfortable part. Valuation is not money. Valuation is a story investors agree to tell each other, temporarily. It's what someone might pay under perfect conditions. Employees don't get paid in valuation. They get paid in whatever is left after everyone else is paid first. And in startups, the list of people who get paid first is very long. By 2019, cracks were forming. Losses were mounting. Governance issues leaked. The IPO paperwork went public. And suddenly, the story changed. Investors started asking questions they hadn't asked before. Why is a real estate company valued like a tech company? Why is the founder borrowing money from the company? Why is the burn rate so high? The IPO was pulled. The valuation collapsed. SoftBank stepped in, not as a savior, but as a surgeon. They didn't invest to save the dream, they invested to salvage what they could. And salvage has a priority order. Here's the part most employees never see. When a company raises money, investors get preferences. These are called liquidation preferences. They guarantee investors get their money back, sometimes 2 or 3 times over, before anyone else sees a dollar. Founders usually get something too. Executives renegotiate. Lawyers get paid. Employees are last. Always last. So when WeWork restructured, the math turned brutal. The company still existed. The offices were still open. The brand didn't disappear overnight. But the equity stack was upside down. Even if the company sold for billions someday, the first billions would go to paying investors back. Daniel's options were technically still there. They just weren't worth exercising.
Then came the layoffs. Thousands of employees were let go. Daniel survived the first round, then the second. By the third, he was done. His exit meeting lasted 11 minutes. HR thanked him for his contribution. His manager apologized. Then came the question he'd been carrying for years. What happens to my options? He was told he had 90 days to exercise them, to pay real money for shares that might never be worth anything. It would cost him more than he had in savings, so he didn't. Most employees didn't. The window closed, the options expired. And just like that, years of ownership vanished quietly. No headline, no announcement, just silence. This is the part that feels unfair, because it is. WeWork didn't go to zero. It didn't vanish. It restructured, it downsized, it survived. But survival isn't the same as success. And equity only pays out in success. Anything short of that, and employees get nothing. Daniel watched the news like everyone else. He saw articles calling WeWork a cautionary tale. He saw documentaries dissecting the founder. He saw memes. What he didn't see were stories about people like him. People who did exactly what startup culture encourages. Worked hard, believed early, took risk, trusted the upside, and still lost.
Years later, WeWork went public anyway, through a SPAC, at a fraction of its peak valuation. By then, Daniel was long gone. Even if he had kept his options, the math still wouldn't have worked. After investor preferences, after dilution, after restructuring, there was nothing left. Here's the uncomfortable truth this story reveals. A company can be worth billions without ever being valuable to you. You can help build something enormous and still walk away empty-handed. Because in modern finance, participation is not the same as protection. Ownership is layered, risk is uneven, and optimism is often doing unpaid labor for capital. Daniel works at a different company now, more stable, less exciting. He gets paid more in cash, no kombucha taps, no hoodie. Sometimes he misses the energy. Sometimes he wonders what would have happened if things went differently. But mostly, he thinks about how close it all felt, how real it seemed, how inevitable the payoff looked, and how quietly it disappeared. The next time you hear about a billion-dollar startup, the next time someone tells you, "We're all going to be rich when this exits," it's worth asking a simple question. Not how big the valuation is, but where you actually sit when the story ends and the money gets divided. Because the bill always comes last, and not everyone gets a seat at the table when it does.